My name is Ann Smith. Today I will be presenting a financial analysis of two firms, Walmart and Target, in terms of financial ratios. I will begin with a short introduction, followed by a brief history and background of each firm. I will then compare several of the more important financial figures, highlighting the firm that holds the dominant position in the market. Finally, multiple financial ratios will be calculated and a DuPont model will be presented. The retail market continues to explode throughout the world, reporting billions of dollars in sales every year. Two of the largest retailers to compete in the retail industry are Walmart and Target. Founded in 1962 by Sam Walton, Walmart began as a solitary discount store in Rogers, Arkansas. Over the last 50 years, the company has grown into the largest retailer in the world. With over 10,000 stores in 24 countries, Walmart greets approximately 220 million customers weekly. Walmart offers several operating divisions, including, but not limited to, retail stores, clubs, and grocery stores. Pardon me. Additionally, the firm offers an e-commerce platform accessible across the globe. The firm continues to offer a highly diversified and reasonably priced product portfolio. Though the COVID pandemic left shoppers weary and the economy shaky, Walmart continued to thrive. The company was forced to absorb millions of dollars related to temporary physical store closures and additional preventative measures related to the pandemic. That said, Walmart's operating profits continued to soar, securing the number one spot in the Fortune 500 list in 2020. Founded in 1962 by George Draper Dayton as a discount offshoot of the Dayton Company, the first Target store opened in Roseville, Minnesota. Over the last 50 years, the company has established more than 1,900 stores in all U.S. states, boasting that 75% of the U.S. population lives within 10 miles of a Target store. Target operations are focused on physical retail locations as well as an online e-commerce platform. The firm offers a diversified product portfolio similar to that of Walmart, including, but not limited to, grocery items, beauty products, and clothing. The COVID pandemic, as mentioned before, took an economic toll on the retail market. Target's COVID-related financial absorption of $300 million included temporary store closures and additional preventative measures. That said, the company has stated that overall sales are more than 20% above last year. Taking a quick look at the differences between some of the most important financial figures, you can see that Walmart far exceeds Target when it comes to profits. In fact, the gross profits of the firm are more than 4.5 times that of Target. That said, this perspective highlights the importance of calculating financial ratios, which will become more clear as we move ahead. Throughout the highly competitive retail market, Walmart and Target continue to dominate. While Target is considered an American retail corporation, Walmart competes on a multinational scale. Due in most part by its sheer size, Walmart continues to hold the dominant position. That said, Target has been carving out market share with catchy advertising campaigns and hip design partnerships. Analyzing corporate financial statements can be tedious and time-consuming for the investor. Thus, the ability to extract the information necessary in calculating specific financial ratios is useful when comparing companies of different sizes, as well as compiling stocks for an investment portfolio. I will be presenting 4 categories of ratios, including short-term liquidity metrics, long-term solvency metrics, asset management, and turnover metrics, and profitability metrics. The current ratio is utilized in calculating the short-term liquidity of a firm and is commonly used in analyzing the overall health of the firm. In other words, the current ratio reflects the firm's ability to produce enough cash to pay short-term obligations or those due within 1 year. Retrieved from the balance sheet, the current ratio is found by dividing the current assets by the current liabilities. Though the current ratio for each firm falls under 1, current economic impact may be to blame. The quick or acid test ratio is another short-term liquidity metric. This ratio is utilized in assessing the ability of a firm to meet debt obligations without selling its inventory or obtaining additional financing. Also retrieved from the balance sheet, the quick ratio is found by subtracting inventory from current assets and dividing by the current liabilities. The quick ratio for each firm is low, but comparable. Again, it is assumed that the impact of the pandemic has come into play. Let's move on to the long-term solvency metrics. The total debt ratio takes into account all debts of all maturities to all creditors. Retrieved from the balance sheet, the total debt ratio can be calculated by subtracting total equity from total assets and dividing by total assets. The result, if a firm has more liabilities than debt, will be greater than 1. Thus, any number that falls below this threshold is optimal. And as you can see, Walmart and Target have the exact same total debt ratio. Cash coverage ratio is a financial metric utilized in assessing the firm's ability to meet financial obligations such as interest payments or dividends. Retrieved from the income statement, the cash coverage ratio is found by dividing the EBIT or EBITDA by interest paid. Both Walmart and Target show satisfactorily that they retain the ability to meet financial obligations. The debt-to-equity ratio is useful in evaluating the leverage of a firm. It suggests the level of debt a firm utilizes in financing its operations, with a value under 2 being the general preference. Retrieved from the balance sheet, the debt-to-equity ratio is found by dividing total debt by total equity. Based on the calculations, both Walmart and Target have an optimal debt-to-equity ratio. Next, we will look at the asset management and turnover metrics. The total asset turnover ratio is typically used as an indicator of the efficiency with which a company is using its assets to generate revenue. As such, a higher ratio is indicative of a higher efficiency in using assets to generate revenue. Retrieved from both the annual report as well as the balance sheet, the total asset turnover can be found by dividing sales by total assets. The retail industry average falls near 2.5, thus each firm is shown to be operating quite efficiently. The inventory turnover ratio indicates the number of times a company has sold and replaced inventory during a given period. Retrieved from both the income statement and balance sheet, the inventory turnover can be found by dividing the cost of goods sold by the inventory. Again, given the vast inventory involved in both firms, the inventory turnover is found to be acceptable. Sales and inventory indicates the average amount of time it takes a firm to turn its inventory into sales. The days sales and inventory assumes a 365-day period divided by the inventory turnover from our prior calculation. This number can vary widely, but seems comparable given the calculations shown. Our final metrics involving profitability is next. The profit margin on sales essentially state what the company generates in income for every $1 in sales. Retrieved from both the income statement as well as the annual report, the profit margin on sales is found by dividing the net income by sales. Based on the calculation, each firm shows a relatively low profit margin on sales. The return on assets metric states the profitability of a firm in relation to its total assets. According to Forbes.com, an ROA of 5% or more is considered good, while 20% or more is considered great. Retrieved from both the income statement and the balance sheet, return on assets is calculated by dividing the net income by total assets. Based on the calculations, each firm has a good ROA, but Target seems to have surpassed Walmart with this particular metric. Here, under the profitability metric, seems to be moving on to the DuPont model. The DuPont model is a framework that is used to decompose the different drivers of the ROE, or return on equity, and is useful in analyzing fundamental firm performance. The DuPont model is inclusive of 4 separate calculations: net profit margin, asset turnover, equity multiplier, and of course the ROE. To the DuPont model, I would also like to state that I retrieved and figures from the financial statements for 2020. I hope this information has been enlightening. Thank you for your time.